let's talk about what the panel is going to discuss now. We're going to be focusing on macroeconomic and geopolitical conditions, including how both those things affect both investor risk appetite and, of course, corporate access to capital. And in a global economy where key variables can affect regions differently, it is more important than ever to consider the factors that drive that volatility. We have a great panel lined up for you. I can see them waiting in the wings. And running this panel, ladies and gentlemen, please give a big welcome to the deals correspondent for EMEA from Bloomberg, Ruth, David, and her panel.
Good afternoon, everyone. Thank you for coming here. Panelists, would you like to start by giving a quick introduction of yourselves?
Sure. Hi, everybody. I'm Stephen Halperin. I'm a managing director, and I run equity capital markets across EMEA for Barclays. So that's our business focused on everything from IPOs to equity-linked transactions.
Good afternoon. I'm Jeff Liu, and I'm a partner at EY. I run our technology industry sector for our transaction advisory services division.
Good afternoon, everyone. I'm Adam Welham. I spent most of my life working on the sell side. I then saw the light and moved to Fidelity Management and Research, where I coordinate all the equity capital market activity in Europe.
Hi, I'm Sam Losada. I'm Swiss and Spanish. I'm a managing director at Bank of America Merrill Lynch, and I run equity capital markets in Europe, advising clients on, in particular, IPOs.
Now, I know it's a hard knock life when you have to come to a city like Monaco for work. And when my boss told me, I said, well, I really want to do the panel, but I'm not so sure about Monaco because the sunshine, especially if you're used to London, is very disconcerting. But I've heard that if Brexit happens, Monaco is one of our top choices for the financial capital of Europe, which leads me to my question. And Stephen, maybe you can start with that. To what extent are investors worried about Brexit, and how is that affecting deal flow?
Sure. I mean, Brexit is a very hard event to predict, right? We all know that, and it's an idiosyncratic, single event that it's either in or out, which will dramatically affect the markets in the UK for certain and across Europe, we think. So it matters on the transactions. For something like an IPO, which is the riskiest product in all of the capital markets, that has effectively shut down the IPO market in the UK, because an IPO is a very difficult, stock to value, company to value, multiple to determine. And when you have a big event like that, that's going to affect GDP, growth, trade, tax, and labor, it makes it almost impossible to bring a meaningful UK IPO. So it certainly weighed on that. But away from IPOs, it's affected markets in different ways. I mean, if you try and bring a bond for BP like we did a couple of weeks ago, I mean, it's BP, it's oil, it's global, sterling is fine, people buy it. But if you try and bring something maybe for a more domestically focused GDP play in the UK, that's a transaction you wouldn't want to bring to market.
Adam, you're the other side, you're the magical buy side. So what are the other risk factors that investors are looking at, especially for IPOs, which are somewhat of an untested entity?
I think the risk factors remain pretty constant. I mean, if you set aside for a moment the sort of macroeconomic background, which is always an ongoing concern, I think risk factors on deals, IPOs in particular, are particular to each of the different companies that come along. We go through a very rigorous process on each deal. I was on the phone this morning with an analyst who's still doing work on a deal that's due to close tomorrow. Doing due diligence with the company, with the seller, going through all the checks and balances that he needs to get to a point at which we can invest. So I think the bigger issues like Brexit, they're important, but more important to us is the individual company and are doing specific work around that.
Okay. And volatility in the market. I mean, Sam, this is something that a lot of people say, well, volatile markets, maybe IPOs are not doing so well. But when you're taking these companies out on the road, what are you seeing?
Well, I think, and to some extent there, I would like to nuance it a little bit. A lot of people are saying there is a lot of volatility. Reality, if you look at the numbers, And some market participants look, for example, at the VIX index, which is this fear factor index, which was north of 80% in 2008 and is currently at 15, right? And it's been since then 3-4 times above 40. So if you look at this, really, is there volatility in the market? I think there is mainly the perception of volatility. But markets are relatively stable, and I think that's probably in the aftermath of the central bank activity, which has been injecting a lot of liquidity to stabilize markets. Mm-hmm. So what does that mean for clients? It means volatility is a factor, depending on the sector, but it's not really the factor right now which is potentially impacting valuations in our view.
What is the factor?
Well, in our view, the factor which is impacting valuations is more the liquidity point. The fact that banks are not able, to some extent, because of the new rules, in particular Volcker rules, to have big inventory of stocks in their books, they can't really provide a lot of liquidity in the market. And that means small movements can rapidly become bigger. And so in our view, that's more the factor we should worry about, is the lack of liquidity in equity markets, which is a point which has been mentioned by many analysts. And central banks are really focused on the credit side, on bonds, on fixed income instruments, but less on equity.
And I mean, one of the things that, we've had Bloomberg data show that IPO volumes are down about 70% this year, M&A volumes similarly. And Jeff, you with your M&A hat on, what's really stopping companies from going out and doing deals? Because we still have people saying the environment is right for deal making to happen.
I think both the financing transactions and M&A are down this year in part because of just contextual worry about global economic growth. We've seen a lot of data points that suggest we may be in a fairly unstable recovery or maybe even a new recession. And I think that's put some pause in management and board minds in terms of going forward with transformative transactions, which are, typically when you're taking another company and trying to merge or acquire it. I think the flip side of that is we are in an environment where there's access to debt capital, there's in many sectors a strong need for innovation to grow, and so there is a big strategic emphasis on M&A. I think though we're at a very good kind of foundational level of both M&A and financing. Here's a disruptive thought. How about getting back to an environment of sustainable growth, improving profit margins, and relatively sane valuations. I actually think that's where we are right now for a variety of reasons that the panelists have talked about. I think actually that's a good thing from the standpoint of private equity capital raises, public raises, and M&A in general.
Yes, I mean, we've seen some IPOs, which I know you all have seen as well, like in Spain, for instance, Parques Reunidos, Telepizza, how their performance has been pretty poor in the aftermarkets. And I guess the question is, what can you learn from these failures?
Not to speak about those specific IPOs. I think business model business and operating model is more important than ever. I'm sure from an investor and a banker standpoint, the validity of a business model in this era, if you will, of capital raising is extremely important. And the context I bring to it is from a tech standpoint. I think we've never been in an environment where there's been more connectivity, a bigger middle class, a lot of disposable income, and some really cool innovation. And if you can't get to a profitable, predictable model in those circumstances, you probably don't have a lot of business, getting into an IPO pipeline or really, expecting a longer lasting future. Yeah. So I think some of those things you're beginning to see just because there have been a lot of companies that have been rushing to do that, and you tend to pick up some companies that don't necessarily have the best business models.
And so, Stephen, I mean, for instance, when you are talking to a company and they say they want to raise funds, what are you telling them? Like, how are the routes? Are you saying also do maybe a convertible or debt or pre-IPO?
Yeah, well, everyone's obviously focused on the IPO, and that's the big event. And you really, in today's market, whether or not, and I'll disagree with Sam a little bit, and it's not just because we have the same job at different banks, but it's not necessarily volatility, but there's a lot of uncertainty out there, and there's been a lot of weak markets and peaks and valleys over the last 12 to 18 months. So you need to find your window to do your IPO and your window of calmness, where investors like Adam and others are willing to engage and they're willing to pay a good value, for the company and for the stock that's buying. So the key is always to prepare and look for your windows, because they do open and shut, and they are slim these days given all the uncertainty we have in the market. So I tell them to do that. But in the meantime, there's lots of other financing that's out there right now. You have a very robust debt financing market that's, it's driven mostly by the ECB buying investment grade bonds in the debt market, but that spills over to all the other bond markets. And you have banks, a lot of banks sitting in the Eurozone with negative interest rates needing to put cash to work. So while you're looking for that window of financing, there's certainly pre-IPO financing, there's bank financing, there's financing tied to equity and future IPOs that's available to fund your company while you're looking for that right window to bring your company public.
Can I just pick
Sure.
up on that? In terms of timing, certainly working on the dark side, at an investment bank for a long time, it's true to say that a lot of advice is given around timing, and whether a market's volatile or whether it's there's a good momentum in the market, for an investment point of view, that doesn't really matter so much to us, because we'll do the work sort of regardless. And if the company's in the right position and the value's right, and that's where we have to do our work, then sort of any time is good. And in fact, you could argue that in times of volatility, it's better for us. We have a stronger hand to play. It's easier to be a buyer in those markets. We get better value, perhaps, because the momentum might not be there. So we'll always, our investment decision is based on fundamental work. We like to meet companies early, meet them several times over the course of the period. So, whilst timing is really important, I don't think our portfolio managers believe that the market's ever really closed.
For anything. And so, Sam, for instance, are there companies from any sectors, maybe, if they come knocking on your door, it's closed and you say, guys, come back next year?
No, not quite that bad, but let's put it this way, deep cyclicals, right? Or in particular, commodity-related sectors who are exposed to ultimately the price of oil and other commodities are right now in a difficult spot, so in a challenging environment.
Yeah.
And I think oil having rallied back above 50 definitely stabilizes the whole sector, but it's still a challenging environment. The other sector which is challenged at the moment in terms of valuation is banks, right? Most banks in Europe are trading below book value, which means either investors think there will be dilution happening or assets will be written down. And so from that standpoint, a lot more work is required on those sectors. But to look at the glass half full, because we spoke about Brexit, volatility, timing, I just wanted to add two points. One is the fact that since the start of the year, we've had limited IPO activity, but in the past few weeks, we had quite a number of jumbo transactions, some of which are closing this week. So there was, same time last year, 5 $1 billion IPO or more in Europe. This year, 0, but 3 happening right now, 2 of which this week. So I think that really opens up a lot the market and opens the way for smaller IPOs. The other thing is M&A and the confidence in the boardroom. I think it's there. Look at deals like Bayer into Monsanto or ChemChina into Syngenta. Those jumbo cross-border M&A transactions really are a reflection of the fact that despite the uncertainty, there is appetite, to do deals.
So you're saying deal appetite still exists, but it just, and I guess valuation is very critical in a bad market, right? I mean, that's one of the points. And then also I'm wondering if we could, very quickly, starting with you, Stephen, if there is a company that's considering to raise capital now, whether it's IPOs or whether it's pre-IPO, what is the one piece of advice you would give them?
Well, I think all of us, whether we're talking about sellers, management teams, or bankers, I think in an IPO we need to be less focused on that valuation day one. I mean, we're all programmed to chase the best multiple, the pedigree of valuing at the smallest discount to our competitors and getting the most value for that initial sale. But the reality is what really matters is an IPO is all about confidence, and people have to have confidence both in the stock performance and the business performance in the medium term. So it's not about that value day one. It is more about how that stock trades in the future, so people feel like it was sold at the right level to the right set of investors, and it will trade well for the long term and appreciate modestly, at least for the long term. And then the other piece is just the business performance, that they bought into a business that's growing, a business that's delivering on their objectives, and a business that they have confidence in that's going to continue to perform. And those two things are what's really set the stage for how a stock's going to trade and how it's going to be owned, and the conviction people are going to have towards it for the next year, 2 years, 3 years down the road. And if you mess that up by being too greedy day one or misleading the market, then that's tarnished, and it's a very hard thing to get back anytime in the short term.
Jeff?
I'd echo a bit of that just by, again, coming back to making sure that you've got the right business and financial model, that it's sustainable over time, that it has expanding margins, and to really look at financing events as singular events over the course of a sustained history of growth for your company. On the flip side, also, just to throw in a note on M&A, I think it's very clear in many industries now that strategic M&A is not a silver medal or a second best result for a lot of companies and shareholders. And so I would continue to expect the M&A market, especially in industries like healthcare and technology, to be a robust alternative.
Adam?
So there are two things really. One, I think be prepared. And by that, I mean, don't mean just go through the process and do lots of due diligence. Really be prepared, and like Steve said, be confident about the projections you're making. There's nothing that annoys our portfolios more than a company that promises something and then fails to deliver immediately after an IPO. So be prepared. And the other thing that I really would urge people to do, and this is obviously from an investor an obvious thing to say, but don't be greedy. I think the experience you have if you have a difficult IPO stays with you for a very, very long time. And the reverse is true. If you have a great IPO, which a lot of people are interested in, and prices sensibly, sets you up for a really good life in the future.
Secondary market, yes.
Yeah.
Sam?
I think my advice would be twofold. First would be to say everyone has seen that we've entered in a long period of stagnation, economic stagnation, with limited growth and not a lot of visibility on the earnings growth for a lot of companies. So really, if you think you have a growth plan, if you think you have a visible pipeline of growth, that's what investors, I think, want. They want to have solid growth, which they can really assess, and you have the track record of delivering that growth. In an environment where there is not a lot of growth, that's what people will be focused on, and most likely will get you into the good valuation metrics. And the other point is, and I don't know if we discuss it later on, but a lot of companies discuss, of course, whether they want to sell themselves to somebody or whether they want to IPO. It's a huge debate, of course, and I'm not going to enter the debate, but the one thing I want to say is don't underestimate the burden it puts on the management to run a real dual-track process until the end. In particular, if you are relatively small, or if you don't have a lot of bandwidth within the management, dealing with both processes at the same time till the end, it's challenging. And so I think you need to really think about that.
Okay. Any questions? Okay, then I actually do have another question. One is the big thing about does size matter? And we keep hearing bigger is better, especially when it comes to IPOs. Do any of you all have very quick thoughts on that?
Sure. So just does size matter? Absolutely yes. Yeah, not necessarily the size of the IPO. I think the size of the free float. Yeah, so what investors don't want is to end up in an illiquid situation where the IPO as a percentage of the overall market cap is small. They want to go into a security which is reasonably liquid. And we've done actually some statistical work on that. And if you look at IPOs where the free float is more than 50% post-IPO versus those where it's less than 50%, clearly over the past few years you can see a significant difference in performance over the first few months of trading. So I think that would be my advice on size. Not the absolute size, but the relative size.
Mm-hmm. And then the other thing is, and Jeff, I know you'd spoken about this before, for a company that's looking at going public and trying to figure out what exchange they should go to, just very quickly, Europe versus the US, how do you play that?
I think the bankers and the investors here would probably observe that for a lot of companies now, with a lot of multinational markets and the ability for capital liquidity to be pretty certain, there's less of a valuation basis to select one market or the other. In other words, where it may have been better to be a technology company and list in the U.S. before, I think there's a strong argument that Europe, we were talking about, is a good alternative. So I think unless there's a specific market or customer reason, I think generally I would ask Fidelity if there's really some indifference in terms of the market itself.
Definitely. I mean, I think we're pretty agnostic to listing location. I think what we really look for is a stock that isn't going to be orphaned. So
yes.
don't go to the States just because you think you're going to get a big valuation when the whole of the company is in the UK. It's happened before on certain situations, and then they end up having to transition. And then in terms of liquidity, yeah, it is really important for us to have the opportunity, in the aftermarket to either buy or indeed sell, stocks. Although, we tend to acquire, if we buy something in an IPO, acquire over a period of time. But then liquidity, arguably becomes a bigger issue as you go further down the line. The need to have banks following the stocks, to have analysts following the stocks. That's really important. Having said which, we do look at every company that comes out, or certainly we'll run the rule over all the deals. We don't necessarily do tons of work on everything, but there have been several deals just this year which have been very, very small, at sort of under $100 million market cap, where if the investment case is really good, really compelling, then we will do the work and we will invest in that company. So really, fortunately, we have the bandwidth to look at pretty much everything.
I think there's one other point I'll just make on the IPO venue question, is that actually as of last fall, for the first time in a decade, European IPO volumes surpassed US IPO volumes. And so I think that shows that actually the European IPO market has been robust and more willing to sort of do transactions in tough markets. And that trend has continued on to this year, where we've seen a lot more IPOs come to market in Europe than we have seen in the US, and the US was shut effectively for the first 2 or 3 months. So I think we have investors that are getting more used to this uncertainty, this volatility, and making decisions in those markets, and more deals that are able to come. So it's certainly a reason why you wouldn't want to shy away from the European markets, particularly if you're a European-based company.
And Stephen, you worked in the US as well. I mean, when you were there, that was 5 years back. Did you see more European companies looking at listings in the US, and do you think now that's totally come off?
Yeah, I think if you were a telecom or a tech company 5 years ago, you really only looked to New York Stock Exchange and NASDAQ. I think that's changed. I mean, you've seen that change in particular industries. I mean, just taking towers, for instance, right? All the tower companies had been listed in the US. Anyone who looked to do a tower IPO looked at the US, and now all of a sudden we have a whole tower. We have 3 or 4 listed tower companies across Europe in different exchanges. So that's shifted, and that wouldn't have happened, or that didn't happen sort of prior to the last 5 years.
And one of the things, I mean, you all both have made points about don't be greedy. I think we've seen valuations in some instances, even in Europe, when you're talking about tech companies, be pretty inflated. And then if you do that, if you go and list, so say maybe from the Rocket Internet stable, then to get your other companies outside and into the markets is tougher. So how do you guard against that, especially in tech? And Jeff, maybe you can speak a bit to that.
I'm sorry, the question was, how do you guard?
Against the high, getting these really high valuations, where is the balance there?
Yeah, I think, it's very difficult to frame a company in some of the new innovative areas of technology or very disruptive areas where there aren't necessarily good comparables to suggest valuation. So there, I really do think that positioning repeatable growth, you've heard both the bankers and the investors here talk about the disappointment that can come if your model fails, especially out of the gate straight after IPO. And I can say as a former banker myself, there's nothing that would more permanently taint a company than missing the quarter or two right after IPO. So having some metric, what we often advise our clients about in terms of IPO readiness is really understanding the metrics of sustainability that can create that substantiation for the growth you're showing, and being very bulletproof in terms of your ability to manage or control against those. I think that can really justify a pretty wide range of valuations, and is something that's very necessary in technology these days, where you have a lot of disruptive business models that really don't have existing paradigms or benchmarks to point to.
Yes.
If I can just add something to that, whilst it's easy to say, don't be greedy, but in the end, it's an investor saying that, right? So on the other side, of course, you want to have a check at the value and make sure you don't undervalue yourself. But the point where I definitely agree with Adam is that the IPO is the beginning of a journey for you, actually. So you want to get the first thing you actually do in the public markets wrong? Probably not. So is the last 10% of value really relevant? It's more like the journey which starts there, and it's going to take a decade after that where you can prove yourself and the value creation you generate. So let's put it in perspective. The IPO is day one. Yeah.
That's exactly right. You look at some of the companies that come, some of the tech companies in particular, where the founders are the ones who are selling, who are clearly in love with their businesses and have clearly been very successful, and as a result of that have a very clear view in their mind what the company's worth. But you do have to listen to the market. You do have to listen to the feedback, and it takes a long time to. If you get it wrong, it takes a long time to get that back. Whereas the other way around, you're set fair for a good journey.
And do you think also some of it is timing, in the sense that if you're coming in a market where it's depressed, then you'll have to accordingly adjust your valuations, even though your company may actually be worth more?
Yeah, just you have to be aware of circumstances, what markets are doing. You can't ignore the market. Whilst I say that we're prepared to look at stuff at any time, you do have to put it in the context of what is happening, and that will have an impact on valuation. But just be aware of that. It's not necessarily going to knock you over and not allow you to get out there and do an IPO. But it just means that you have to be that much more aware of what the limits are.
And finally, for companies that are looking at these markets, is there anything that stands out for you this year? We've talked about volumes, we've talked about volatility. Anything else that makes this year different from the past that the companies should be keeping in mind?
I certainly don't think that this year has been extraordinary from that point of view. I think it's been a year where there's been less happening. And that, I think, is due to various things. We talked about Brexit. That certainly hit the UK market. I think also coming off the back of a period where there's been a huge amount of activity in IPOs, and that's pretty much globally. We've been through a cycle of PE exits, which have provided a huge amount of liquidity in terms of deals coming, and that's slowed down a bit, and I think that's understandable given the cyclicality of their businesses. But no, I think this year has been just a little bit quieter, but I don't think there's been any specific trend or other factor really hitting it.
Yeah, and the lack of that, sorry, but the lack of that is probably actually what defines the market right now, right? It seems like investors lack conviction, and therefore the market lacks direction. And that's just because of all these events that are hanging around. There's some pretty big short-term uncertainties and long-term uncertainties when you start to get into China, commodities, oil, what's the right price for oil, and then Eurozone, integration, growth, and all those items that are long-term weighing on the market. So without conviction, it just seems like we're lingering here and range-bound with some pretty weak, performance year-to-date at various indices. And I think that's the market we have for this year, and I don't see much changing that. We may take some uncertainty, off the list, but the other events will still be there that'll weigh on everybody's minds and impact every type of investment.
I was just going to say, from an M&A perspective, we've had 6 or 7 quarters of record volume up until these last 2 quarters, and we've seen a definite pullback. Our firm, EY, does a survey of global executives called the Capital Confidence Barometer, and I think this past quarter, roughly 80% indicated that they felt that the new normal for the next several quarters was going to be an economic slowdown, heightened vulnerability to quarterly performance, and I think that's affecting also both the M&A and the equity markets.
Okay, so to just sum up, be patient, be prepared, don't be greedy, and hire the right advisors, right? Thank you all so much.